Hi, I'm Patu from freefincal. Today, let's take a look at the new offering from Motilal Oswal, the S&P 500 index fund. And there's been a lot of buzz about this, but there are many things that you need to recognize before you want to put your money into this. So let's consider these points. I have several graphs lined up. I cannot show all of the graphs in the video. It's better for you to go to the article which is linked below in the description and explore all the graphs, or just go to freefincal.com and that's the first article that you would see. So why do you want to invest in this fund? I mean, I can classify the kind of people who are interested in this as into two: people who have seen the US market zoom up after the 2008 crash, and the people are going to assume that, hey, now we have a buying opportunity, it's going to do the same like what it did in 2008. People are going to if you belong to that kind of a belief where your interest in this is completely governed by recency bias, then good luck to you. I think most portfolios of such people would already be cluttered with 10 11 funds. What is the one more fund going to do? It's not going to do anything positive, or it's not going to do anything negative. Go ahead and invest. The other question is, can I use it for diversification? Some people say, I want to have some exposure to international fund for the benefit of diversification. This is the kind of thing that they ask in the forums. Does it even make sense? Do you first of all know how to measure the benefits of diversification? I asked this question in a video. Nobody answered. Nobody answered. And the people who watch my videos regularly, none of them knew how to measure the benefits of diversification. So if you know how to measure, you must first ask yourself, is there any anti-correlation between Nifty, that is our market, and the US market? There should be an anti-correlation for diversification. There is, both of them should not go up and down in the same direction. If one goes up, one should go down ideally. Even if that doesn't happen every time, it should happen often enough for you to consider the benefits of diversification. Of course, one thing is clear: if there is a worldwide crash like this, worldwide problem like this, then everything will crash. Even debt funds are crashing, so you'll have to be careful about that. So we have to check the benefits of diversification. We will do that. And the second question is risk premium. That is, you are taking considerable amount of risk, whereas you can invest in something which is risk-free here. For example, long-term gilts. The return that you get from the US market in INR, that is after you convert the USD into INR, that return should be greater than the return that you get from a gilt investment here, long-term gilt investment here. Then only then you are justifying the risk, that additional risk that you are taking. That's called the risk premium. So that also let's take a look at. And please recognize there's no hurry for you to invest in this fund. So what if this is the NFO period? You can always go invest later. First, let's find out what is the AUM collected. If the AUM is too low, then they will have trouble tracking 500 stocks. The expense ratio is high or low, we have to see. Let's wait for all this. Let's see the tracking error. Let's wait for some time and see what is the big hurry. And you may say, oh no, US market is down, this is a big buying opportunity. If that is the case, go ahead and invest. Why do you want to see this video? But then you are not going to, if you are going to just make only one investment in this fund, then it's fine. But if you are going to continue investing in this fund, then what's the big hurry? It doesn't make any big difference over the long term. Alright, so with that said, we should first recognize the exchange rate plays a very crucial role. That is the S&P 500 in INR, the black line, the red line is the USD. This is of course only one return data point measured from January 1990 to April 2020. That's just one return data point. You'll have to look at the rolling returns, and you will see that you cannot expect the S&P 500 INR to always beat the USD. You don't expect that. That's not correct. Most of the intuitive this mind feel I get a feeling, I have this, all these feelings will not be borne out in data most of the time. Alright, so let's take a look at the 5-year returns of the S&P 500 versus the Nifty 50. The blue line is the Nifty 50, the brown line is the S&P 500 in INR. Notice that before September 2012, The Nifty was significantly higher, the reward from the Nifty was significantly higher, then it came down, and there is some kind of, the correlation is not 100%. You can expect, you can see that from September 2012 onwards, the S&P 500 has outperformed the Nifty, and therefore it can be used for diversification. However, if you think, look, in this case, S&P 500 was less, now it has more, then could come down, then it's a problem, because the US is probably going to face a bigger recession than it did in 2008. The number of people who have lost jobs is, I think, higher, if I'm not wrong. And so the stock market may not, even if the stock market recovers quickly, it may not grow as fast after that. So please be careful, and don't expect the post 2008 scenario to repeat itself now. That may not happen. This is 5 years, and I've also shown 10 years and 15 years that you can check in detail in the article. I'm not going to dwell on that. So now I want to talk about the risk premium. The green line that you see is the long-term gilt return from the IBEX. That is it is a sovereign bond index of India, long-term sovereign bond index. The purple line is the USD INR exchange rate, which is about 5-6% roughly. Notice that if you look at the 5-year returns, the brown line, which is the S&P 500 INR, does not always beat the yellow line, which is S&P 500 USD. It does not always beat it, so you don't expect the exchange rate to always play in your favor. It may or may not. And you can see that only recently the S&P 500 has outperformed the Indian gilt index. So you may not always get that risk premium. And if you believe in cycles, outperformance by S&P, you got risk premium here, no risk premium here, risk premium here, no risk premium here. Then it may come down, and then you may not get risk premium if you believe in the cyclical nature of the markets. I've also shown the SIP returns, 10-year returns, etc. But that you can check in the article. So the main point is that please don't expect returns like last time and buy it. You may be disappointed. Don't go with recency bias. That will be dangerous. You must have 15 to 25% in your portfolio of this fund or international exposure for such diversification to make a difference in your portfolio. So you must be ready for that. So unless you're ready for it, don't buy this fund. There's no real hurry for you to get to invest in this. Of course, you can expect it to be of lower cost than US blue chip fund and other feeder funds. From that point of view, this may be beneficial, but don't expect the expense ratio to be too low. We have to find out what it is. We don't know. Let's see how things go, and don't invest for wrong reasons. Then you will be disappointed. So please check out the articles for all the full details and all the full list of considerations. I'll catch you later. Thank you for watching. Bye bye.